Hey, welcome to our 15 Minutes of Fire. I am Bernadette L. Harris. I'm the CEO of the BTB Advisory Firm, and I am an award winning small business accountant. And I've been helping small businesses stay in business for the last 20 years. And so, if you are joining me for the first time, this is our 15 Minutes of Fire. This is a session where I share relevant information that's going to help you stay in business. So tune in on Wednesdays at 8:30 Eastern, and I'll log in and share some good stuff in 15 minutes. So today, before we get started, I want to just share a little bit of information with you about something that I have coming up. It is called the Strategize Your Success. It is a virtual strategy session for small business owners who are looking for the roadmap to success. So I'll put the link in the comments where you can get more information about this strategy session. But this strategy session, again, is for those driven entrepreneurs who are looking for assistance with creating a roadmap or plan to get to the things that you're trying to get to. So imagine trying to go somewhere new and you don't have directions. It's not easy to do. And so this is what our strategy session is going to do. So let's get to it because we only got 15 minutes. I want to jump right in. Tonight, we're going to talk about understanding your filing requirements when it comes to taxes, understanding as far as what you need to file and when these things are due. One of the things that I've seen in the 21 years that I've been working with small business owners is a lot of times business owners just don't know. And that's the reason why I do these sessions, because even if you're not in a position to be able to hire me as your accountant, I still want to give you some information that's going to help you to be able to stay in business. And so one of the things that I found is a lot of business owners don't know or understand their filing requirements or understand the deadlines or the penalties for not reaching those deadlines. So let's talk about it. So there are a couple of taxes that we're going to talk about tonight. The first tax that I want to talk about, we're going to start with the one that we're most familiar with. That's our income tax. And so this is the income tax that you pay to the IRS, right? And then if you live in a state that has an income tax, you may pay this tax to your state. So there are a few states that do not have a income tax. Georgia and Texas are the two that come to mind. But there are about 5 or 6 of them. I can't name them off the top of my head. But there are a few states that don't have an income tax, but the rest of the states do. So when it comes to your income tax, what you pay as a business owner really depends on how your business is structured, how your business is set up. So let's talk about the different structures, and then we'll talk about what the filing requirements are as well as the due dates. So if your business is set up as a sole proprietorship, then that means that even if you're LLC but if you're taxed as a sole proprietorship, that means you file a Schedule C. A Schedule C is an additional form that goes with your 1040. So your business and personal tax return are essentially filed at the same time. Your Schedule C is where you will report your income and expenses for your business. This Schedule C is due when your 1040 is due. And so the 1040 is typically due on April 15th, unless it falls on the weekend. And so your Schedule C will also be due on April the 15th. The next business structure may be a partnership. And again, you can be a limited liability partnership, or you could be an LLC taxed as a partnership. If your tax treatment is a partnership, then this means that you will file Form 1065. Form 1065 is a separate tax return. And I like to call it more of an information return or pass-through return because the entity itself does not pay taxes, but the entity does have to file a tax return. So this tax return is going to tell the IRS how much money you made, how much money you spent in the various categories, what your profit was from your venture or loss, and who the owners are. And whoever the owners are of this business, those owners will file their share of the profit or loss on their personal tax return. So the owners will receive what's called a K1. and the K1 will show their share. So if you and our business partners and we have a partnership, our partnership made $100,000, we spent $50,000, and we have a $50,000 profit. We're 50-50 partners. I will get a K1 that says 25,000. You'll get a K1 that says 25,000. I claim my $25,000 share of the profit on my taxes, and then you would claim your $25,000 share on your taxes. That's the reason why it's called pass-through, because it passes through to the owners of the business. Now, one thing to note about a partnership return is the partnership return is due on March the 15th. And if, of course, if the 15th falls on a weekend, then it's due the next business day. Well, March the 15th. And this is very key because a lot of times I've seen partnerships that did not know that their return was due before the personal tax return is due. The other thing that is very important for you to know and understand is that when you file a partnership return late, the penalties are brutal. So the penalty for filing a partnership return late is $200 at the time of this recording, $200 per partner per month or partial month. So you and I are partners. There's two partners in the partnership. If our return is 1 month late, that's a $400 late penalty. So you don't want to file your partnership return late. If you can't file your partnership return by the deadline, make sure you file an extension so that you don't get hit with those late filing penalties. The next type of entity would be an S corporation, and this could be an INC that has elected to be an S corporation or an LLC that's elected to be taxed as an S corporation. In this situation, this return is very similar to the partnership return. It is Form 1120S, and just like the partnership return, the S corporation does not pay taxes. The tax liability passes through to the owners of said S corporation. So in the same example that I just gave about the $100,000 income, $50,000 expenses, $50,000 profit, you and I are partners in the S corporation. We each claim $25,000 on our returns, and that'll be reported on our K1. One thing to note about an S corporation is you can have one owner in an S corporation. So if I'm the only owner of my S corporation, then my K1 is going to show the entire $50,000 profit. And then I report that $50,000 profit on my personal tax return. Just like the partnership return, the S corp return is due in March as well, March 15th or the next business day if it falls on a weekend. The last return I want to talk about for income tax purposes is a C corporation. And this return is Form 1120, no S, 1120. And the 1120 does pay taxes. So it is the only entity of the three, the ones that I just named, that is not a pass-through entity. So a C corporation will pay taxes on the profit. So in that same example with the $100,000 income, $50,000 profit, $50,000 expenses, $50,000 profit, a C corporation will pay taxes on that $50,000. So it doesn't matter how many people own the C corporation because the owners will not pay taxes on the profit. Only the C corporation will pay tax on the profit. Now, as far as the filing deadline, the C corp tax return is due on April the 15th. Okay, so that's it for income taxes. I want to talk about some other tax returns because there are a lot of times where people don't think about these as tax returns and get in trouble. So the next thing that I want to talk about are payroll tax returns. And payroll tax returns apply to any business owner that has employees. So if you have employees in your company, by definition, employee is someone that you actually issue a W-2 to. So if you have employees in your company, then you have to file payroll returns. So those returns are typically filed quarterly. There are some exceptions where if your payroll is small enough, you can file an annual return. But typically, this return is filed quarterly. The form is called 941, and your 941s are filed on a quarterly basis. So the first quarter ends in March. Your 941 will be due in April. and so forth, right? And just kind of follow suit. I'm not going to go through the whole calendar, right? So it's typically the month after the quarter ends, the 15th of the month, that your 941s are due. Very important that you file these returns on time. Really, it's important that you always file your returns on time. Even if you can't pay the taxes, you want to always file your returns on time, because filing on time will keep you from getting a failure to file penalty, which can be brutal. The other thing is a 940. A 940 is an annual tax return that you will have to file when you have employees. And this is a return that reports, I'm sorry, the 941 reports your Social Security and Medicare and your withholding tax, federal withholding tax. The 940 is the form that actually reports your federal unemployment tax. This is an annual form, so it's due in January of the next year. Then you, depending on the states that you live in, you may have to file a withholding tax return in your state, as well as a unemployment tax return in your state. So I want to get state specific. We want to keep it on the federal level. Of course, you know that you have to file your W-2s by the 31st of January in the ending year. So 2022 ends in December 31st. You got to file your W-2s and send them to your employees by January 31st. 1099s. This one is something that I've spoken to new business owners a couple of times, and they didn't realize when they had to file 1099s or they had to file 1099s. And so if you work with an independent contractor, so if you have someone that you're paying in your business, they have a business, you pay in their business. So it could be a virtual assistant or a social media manager or someone that you're paying in your business. If you're paying an individual or a single member LLC, then it is very likely that you're going to have to issue them a 1099 at the end of the year. So these are the parameters of when you have to issue a 1099. Number one, you have to have paid them with cash or a cash equivalent. So cash, of course, you know what cash is, right? But cash equivalents are things like checks, bank transfers, ACH payments, Zelle, Cash App, Venmo. Those are all examples of cash equivalents, right? And so if you pay them with the cash or cash equivalent, that's one qualifier. The second qualifier is that you paid them over $600 in a calendar year. And so if you paid them $599, you don't have to issue a 1099. They still got to claim the income, but that's on them. But if you pay them $601, you have to issue a 1099 for the payments that you've made to them. And so that's one. Now, the exception to it is if you pay someone with a credit or debit card and you pay through like their payment processor. So I use QuickBooks to send my invoices in. I get paid online through QuickBooks. If you pay through QuickBooks or Square or Stripe or PayPal, something like that, or you swipe your card on their machine, then you don't have to issue a 1099 for those payments, because those payments will get reported by the merchant processing service. So they'll get a 1099K for those payments. It gets a little tricky, but this is why it's so important to have a good record keeping system, because when you have a good record keeping system in place, it will keep track of all of these things for you. So that's the 1099. The last tax that I want to talk about, and then we're going to wrap this up, is sales tax. And again, this is something that is going to be dependent on your state. The state rules are different. And so I'm going to speak very generally about this. And then again, you want to meet with your accountant to discuss how this applies to you in your state. So if you sell a tangible product, typically you have to charge sales tax and remit those sales tax payments to the state. The frequency is determined by the state. So typically when you get your sales tax number from the state, most times they will automatically, like in Georgia, I'll use Georgia as an example because that's where my business is located. So in Georgia, they will assign a frequency, and typically that frequency is quarterly. And then based on what your volume looks like, if you selling a whole lot of stuff and they see that your sales tax is a lot, then they'll switch your frequency to monthly. If you're not selling a whole lot of stuff and they see that your sales tax is a little, they may switch your frequency to annually. So the key is to make sure that you understand, one, if you should be charging sales tax, and two, if you should, make sure you file those returns on time. Because again, filing your sales tax return late can cause you a penalty. And most jurisdictions or states or whatever will give you a discount on your sales tax if you file those returns early. So I hope this information was helpful for you. If you have any questions, put them in the comments. I'll definitely come back and answer any questions that you have. Again, I'm Bernadette L. Harris with the BTB Advisory Firm. You can find out more about me and my firm at the btbadvisoryfirm.com. And if you're interested in our strategy session, you can also check that out on our website. I will see you guys next week.